This week's number, 15. That's how many times bigger Buckingham Palace is than the White House. True story, when you turn 100 in the United Kingdom, you get a letter from the Queen. When you turn 16, you get a text from Prince Andrew. Welcome to Prof G Markets. Today, we're discussing more trouble in regional banking, Coinbase's shareholder lawsuit, and the Miami Formula One Grand Prix. Here with the news is Prof G media analyst Ed Elson. Ed, I couldn't decide. I was trying to figure out a way to call Harry and Meghan those Instagram-loving bitches.
What I can't wrap my head around is why every single joke has to be a sex joke about. I mean, what was last week? Last week was a sex joke about dead people, was that right? And this week got
also
pedophile joke.
You have told that joke before, I will say.
I know, but you got to recycle the good stuff, Claire. You got to recycle the good stuff. Anyways, enough of this. Enough of heckling from the cheap seats from the 22-year-olds. Yeah, I don't know if you guys know this, but you should look at who signs the front of your checks. His name is Dog, D-A-W-G. Yeah. Anyways, Ed, break down the headlines.
Great joke, Teller. All right, let's do it. Okay, let's start with our weekly review of market vitals. The S&P 500 posted a week of losses. The dollar also fell. Bitcoin climbed, and the yield on 10-year treasuries slid through the week before surging on the latest jobs data. Shifting to the headlines. U.S. unemployment fell in April to a 50-year low at 3.4%, signaling continued strength in the labor market. The Fed raised rates by 25 basis points to a 16-year high and signaled again that a pause could be imminent. Johnson & Johnson's consumer health unit, Kenvue, made its debut on the public markets. We previewed that on last week's show. The stock surged 22% to value the company around $50 billion. That makes it the biggest US IPO in over a year. Apple posted its second straight quarter of declining revenue, but the stock still rose 4% on the company's strong iPhone sales, particularly in emerging markets like India. Meanwhile, Apple's high-yield savings account, which we covered a few weeks ago, that brought in nearly $1 billion in deposits in its first 4 days. The launch day alone netted $400 million. Match Group, which operates Hinge and Tinder, is pulling its apps from Russia over human rights concerns. Meanwhile, the company reported direct revenue at Hinge increased 27% year over year. Those double-digit subscription costs that we discussed on a prior episode seem to be paying off. Vice, the edgy media startup once valued at $5.7 billion, is headed for bankruptcy. The company is searching for a buyer willing to pay a fraction of that to avoid going out of business. Shares of edtech company Chegg were cut in half after the company said ChatGPT is starting to hurt its customer growth rate. Other companies in the sector also took a beating, with Pearson, 2U, and Duolingo down more than 10%. And finally, Hindenburg Research released its latest short seller report on Icahn Enterprises. That's Carl Icahn's investment firm. Shares of the company declined 20%. That's the largest one-day drop on record. And Hindenburg's report claims Icahn Enterprises is overvalued by 75%. And it also questions the legitimacy of its 15.8% dividend yield. Scott, where shall we start?
So let's be honest, these Hindenburg folks are total ballers. I mean, everyone, generally speaking, I advised a bunch of hedge funds in a previous life. Everyone was scared to death of Carl, as in Carl Icahn, because he's known as being very litigious, very angry, and well-resourced. He's not afraid to just try and sue people into oblivion. And so for them to target Icahn Enterprises is just a ballsy move. And the notion that a 16% dividend yield based on your trust that they were such great investors, that in itself feels strange. Mm-hmm. And I think, aren't they claiming that he's taking new investment money and pooling it and then using that, commingling those funds with what goes out to meet that 16% dividend, which is literally the equivalent of a Ponzi scheme, as far as I understand it. So this is a baller move. The ed tech stuff, essentially what we're going to have is, if you read about AI, they say, okay, this will hurt paralegals, it will replace teachers, replace lawyers. So one by one, the market is going to find industries that are vulnerable, and it'll be set off by a spark. I think they screwed up here. I think the Chegg should have just said AI over and over and over in the earnings call, and basically said how AI is going to make them a much better company. I guess full disclosure, they said that in fact that AI was going to hurt their business, or that it was cutting into their business. But this entire sector is getting taken to the woodshed. I also think we're going to find out that a lot of short sellers have millions and millions of bots. They load up on a short position, and then they start circulating these negative stories. I would argue it's even happening right now with some of the other regional banks that seem to be on more solid footing, but the media loves to find the next target. Vice should have died sooner. You're young. Do you watch anything from Vice except for my show, which was a hugely underappreciated show?
You're an employee. What happened with that show? Did you get fired, or was it a dud? What happened?
I'll tell you what happened. So it was COVID, and they said, we want to do a show with you. And they did a show with me, Anand Girdadas, the other another thought leader, so to speak, smart guy, great hair, by the way. And they did a show with, who else did they do a show with? I forget. They picked like 3 or 4 of us to do shows. And my show, it was actually, according to them, a hit. I think I was like the fastest tortoise, if you will. And they ordered 6 shows or 8 shows. I did 8. And the first show that aired, it was COVID. We did it out of my garage. Drew literally pulled a rabbit out of the hat. And we figured out a way to produce a TV show from my garage. And I just hated everything about it. And then we screened it in my house, and my partner started crying about halfway through it. Like, what does this mean for us and our children? It was just so bad. She was literally worried about my career.
Because it was so unhinged, or what?
It was like watching an old man have an epileptic seizure. They tried to make it really young and cool, and
that's what they want.
Flashing lights everywhere. It really was. It was awful. And the interesting thing that gives you insight into Hollywood is the guy who ran TV at the time for Vice called me and said, I've got great news. Your show's doing well. We want to order another 8 or 12 episodes. And I said, no, I just want to get through the last 2, and then I never want to speak to you again. And I never want to utter the word Vice unless it's me, taking Molly and explaining why I take Molly. But by the way, kids, don't do Molly. Although it was fun in college. I got to say, in college, it made me feel better about me and the world. Anyways, that's neither here nor there. They're just, people love to be on TV, and I'm like, I want nothing to do with this. I thought it was awful, and then I went on to do Bloomberg, then CNN. Anyways, that was this.
You did 2 after that. It can't have been that awful, right?
Well, I'm the COVID-19 of TV networks. I take weak TV networks and I put them on a ventilator and then I kill them. So Vice, they should have known it was the beginning and the end when they had me do a show.
Yeah.
But Vice has never, in my opinion, I've never understood how Vice makes money. I've just never understood how they spend all this money, and I never see it in the news. I never see it as part of the cultural zeitgeist. They've been trying to sell this thing for parts for 2 years. At one point, I think it was valued at $6 billion. Mm-hmm. So to me, it's not. The question isn't why are they going out of business. The question is why it took so long. Online dating continues to be a bigger deal. Hinge and Tinder pulling out of Russia means they weren't making any money in Russia. That has nothing to do with, in my opinion, any sort of fidelity to the Commonwealth. I think online dating is creating incredible mating inequality. What I would tell anybody, especially young men, is to get off of dating apps. If you're in the lower half of attractiveness, as referenced by what the algorithm thinks is your relative level of attractiveness, you have to swipe right 200 times to get a match. And then I guess the math is 4 out of the 5 people who actually match back with you will ghost you for whatever reason. They go back and see, oh, Ed's not as handsome as I thought, or whatever. And then, so you have to swipe right. You have to decide that you're willing to meet with someone 1,000 times to get one date. And it just provides a lot of people with confirmation that they don't have value on the mating market, specifically young men. And it creates this sort of income inequality. The most interesting data I've seen on Tinder is that if it were a country and an economy, it would have greater inequality than you have income inequality in Venezuela. And that is the top 1% of attractiveness, especially among men, get all of the interest. The bottom line is everybody has access to everybody. Women have much finer filters than men. And when men can't use their humor, their vibe, that shitty aftershave that you use. Anyways, there's no chance. The top 1% are getting, just as the top 1% in America are getting 90% of the income gains, the top 1% of males in terms of attractiveness. And women, it's not as bad because the bottom line is the majority of men are much less choosy than the majority of women. And so I don't like these companies. I don't know what to do about it, but I'm fascinated by it. But it's no surprise that they're going to start implementing different criteria to give you a chance to upgrade by a thinly veiled messaging of saying the chances of you getting laid or getting a match are better if you upgrade to the super stud level. I don't know if that's happening here, but it doesn't surprise me. We predicted with Apple that they would bring in that this was going to be a winner. I'm shocked it's not more. $1 billion is real, but I would bet by the end of 2024, if not sooner, maybe by the end of this year, they will be bigger than the majority of the regional banks that almost caused a banking crisis that have been in the news every day. This just feels like they're going to come up with new add-ons, new services, new banking products. So I think this is, to be expected. Any thoughts on your end?
Well, first off, I just want to talk about Chegg, which is it got cut in half because ChatGPT is threatening the business. The question that I would pose to you is, it feels like that is a dramatic over-punishment of the stock, considering that ChatGPT and all of these AI products are basically threatening every single business in existence, and combined with the fact that Chegg is actually planning on implementing GPT-4 to create its own AI product. And what I increasingly feel about these companies and their implementation of AI is that ChatGPT and its AI model isn't a product that's going to compete with these companies. It's going to be a product that they will implement into their own businesses, and they'll start spinning off their own products based on that underlying AI model. It doesn't feel that ChatGPT alone is the product that's going to take down all these companies. It feels like it's going to be the thing that unleashes their potential. I'm wondering if you would agree with that, and if you would agree with the notion that 50% reduction in the stock is far too low.
The market is bipolar. The market is either manic about a stock and has an outsized, we can do no wrong, ignore the risks. The pendulum is never at the very bottom when it comes to a market's impression of the stock. So has it been overpunished? Yes, but does that mean it can't go down more? Because the communications and a narrative has momentum. And now the narrative around the edtech space is that AI is going to cream it. And every media reporting covering education will look for evidence to validate that thesis. There'll be the mother of all confirmation bias, and anything that shows that people are using ChatGPT to create their own curriculum or it's a great tutor is going to take these stocks down further and further. And also, this was a bit of a spark for what was an explosive kind of lying fallow, and that it was an unexploded IED, in the sense that online education, and I know this having started an online education company, the disruption we were all waiting for in the massive torrent inflow of capital and business, to be blunt, hasn't happened. We got huge wind in our sails through COVID. It's like, okay, I'm hanging at home. I'm going to take some classes. We experienced this at Section 4. Our revenues quadrupled in 2 quarters. And we knew that we had unfair advantage through COVID. What we didn't realize was how much the business would drop off post-COVID. And this has happened across the entire sector. People do not want to be in their homes staring at a screen, learning statistics. And while it's come back a little bit, it still hasn't recovered anything resembling what we were experiencing during COVID. So the market was looking for an excuse to take these companies down, and it got it with this acknowledgement that ChatGPT might be damaging the whole ed tech sector. The more interesting question is, what is the next sector that everyone will identify as the sector vulnerable to AI?
Mm-hmm. Yeah. And then I just want to pivot finally to the Hindenburg report. You were mentioning the skepticism over the dividend yield. So just to add some color to that, the dividend yield for Icahn Enterprises right now is 15.8%, which is the highest of any US large cap company by far. The next closest is 9.9%. And basically the claim that they're making is that dividend is entirely unsupported by the cash flow and investment performance of the company, which they point out has been negative for years. So as you pointed out, it's this idea that they're taking investor money and then they're distributing that investor money in the form of a dividend yield, which makes the stock look more attractive. I'll just read out the quote that they said in the report. Given that the investment and operating performance of IEP has burned billions in capital, the company has been forced to support its dividend using regular open market sales of IEP units through at-the-market offerings totaling $1.7 billion since 2019. So you mentioned this is Ponzi-like, or to be more blunt, it is simply a Ponzi. Is this not cause to go to jail? Is this not maybe something bigger than just the stock goes down?
I don't think Carl Icahn goes to jail. I think he's too well advised by a number of lawyers. It might effectively be the same concept as a Ponzi scheme, but if you have a hedge fund that's creating profits through its sales of stock or companies that it takes a large position in, and that the question is whether those funds are pooled with new inflows and whether they should be separated. But you said that this company had a 16% dividend. It doesn't as of today. As we tape this, the stock's off 8% today. The dividend yield right now for Icahn Enterprises is 25%, which is just staggering. And that's not sustainable, right? So the market has taken this down and said, this makes no sense. And now it's no longer yielding 16%. If Icahn were to come back, and you can bet he will, at least from a narrative standpoint, and said, you guys this is slander, this is not true, we have done nothing wrong, we will have no problem continuing to make these payments through legitimate cash flows and profits from our unique approach to investing. And Carl, to be blunt, has been one of the most successful investors in history.
Yeah.
Then, this is the buy of the century, because if they could maintain these dividend payments and convince people that you're just going to get your money and don't worry about it, and no one's ever going to accuse us or prove that we're in fact a Ponzi scheme, that this is dividends that are being garnered or paid out based on our enterprise's ability, again, to identify asymmetry in the market and dislocation and invest at X and get 1.25X back every year, then this is the deal of the century. So what's really interesting is if they decide to cut, this can be fascinating. How do they respond to this? Do they get aggressive? Carl is not, a wallflower. I imagine he's going to come back guns blazing. What is interesting, if he comes back guns blazing, is he going to reconfirm or recommit to the dividend? And at 25%, Jesus Christ. That's staggering, right? If you reinvested that dividend back into the stock, that means effectively every 3 years you're doubling your principal without the stock even going up. So something's got to give here. This seems very strange. This will be, I think, for people in the finance sector, one of the stories of the year as it relates to dividends and payouts. And he is arguably the most iconic, or one of the most iconic people in the history of finance. You've done more research here. What do you think is going on? And that's Latin for me saying I don't want to get named in a suit. Oh, no, Ed, we fired Ed. We fired Ed. We were wrong, law firm representing Icahn Enterprises. We got rid of. You're absolutely right. This was irresponsible. We have fired that young British guy.
No, the truth is I don't know enough other than I've sort of browsed through the report. And, in our last discussion of a Hindenburg report, my first glance review was that the report didn't really have much to say. It was about Square, and it was criticizing that they were, that people use Cash App to do illegal things, and the reality is that everyone uses any form of payment to do illegal things. There are things that are illegal in the world, and people use money to get them done. This one feels different. I mean, I think what I've found is anytime that there is an investment opportunity that is too good to be true, in this case, a 25% dividend yield does feel too good to be true, there's something wrong with it. And the fact that they have identified what that problem is, the fact that they've matched up the dividend yield in comparison to the cash flows and the investment performance of the company, to me signals that they're on the money here. You know, they've compared the way that they've marked up their valuations on their real estate assets and their investment assets, and they're outlandishly high in comparison to other hedge funds. This feels legitimate to me. The question to me is, as you point out, how is Carl Icahn going to respond? And do people, considering Carl Icahn's legendary status, do people trust him more, or are they willing to buy Hindenburg at this point? Because, you know, Hindenburg appears to be making its own legacy name for itself. The stock's down 20% just because they released this report. As you were saying the other day, they can seriously move markets, which to me signals that Hindenburg may be becoming the next big legacy firm that can really influence the way people think about finance.
Like, my vote for financial services or investor of the year is Hindenburg. It just strikes me that they bring such incredibly robust work, whether they're right or wrong, you could argue with, but they are moving markets. I think the most interesting thing, if I were the head of Hindenburg Research, one, I would be doing champagne and cocaine in St. Bart's because I'd be much richer than I am. But the second thing I would do is I would say, all right, let's really test our skills here. Let's go find a company that's undervalued.
Yeah.
Because you could argue they're trying to find asymmetry in the market. They're trying to find businesses that don't justify the valuation, which arguably should be the same, or at least some of the same skills you use to find a company whose valuation doesn't reflect the strength of the underlying cash flows in the business. So I think the way they kind of starts their hat wide, if they're even interested, because there's something about short selling where you sort of put on an air regulator and turn into the Dark Lord of, you know, the Sith Lord or whatever it is. I'm trying to say you become Darth Vader. Anyways, the way they would become sort of the iconic, if you will, investor of this decade would be if they made a couple extraordinary long calls.
Agreed.
And it moved the stock up. Because the thing that I find uncomfortable about these calls around a short position is I think we're going to find out that in a world of immediate response and constant updates and alerts on your phone with news and the ability to trade right away and move capital around and buy and sell immediately, is that the social media platforms and the media has been weaponized. And that 100%. Is, I just wouldn't be surprised if short sellers or people on the long side have dozens, hundreds, thousands, millions of bots that take a narrative and that presses on the soft tissue of a company and explodes it, hoping that this distributed decision-making creates a run on something. So, for example, there's now, I don't want to even say their two names because I don't want to add to the frenzy, but there's two new regional banks that people are worried about. Yeah, well, there you go. We're going to. Because it makes for great headlines. It makes for a lot of clicks, which sells more Nespresso pods and more Nissans. And short sellers have a vested interest in more of this news circulating. So wouldn't they be smart to create a bunch of fake accounts and then circulate these stories about doubts about these? Because you don't even have to say whether or not, you don't even have to publish the data on whether these banks have the right liquidity ratios. All you have to say is this bank is next, and the crisis is not the crisis is not over. These banks are vulnerable now. And people with phones go, well, if I have a $500,000 deposit at this bank and the FDIC is only up to $250,000, at least theoretically, why on earth would I just take 2 minutes and transfer the funds to another bank? So there's a collision here of the distributed information economy and mobile phones and information that can be weaponized, and also that has a lack of fact checking, where anyone, if they say it often enough, it's like ubiquity creates veracity. And if I'm seeing everywhere that something is vulnerable, it seems to make it true. So I don't know. This for me is more a story about an information age that we live in and how you can weaponize media as it is about the underlying health or lack thereof of these companies.
Yeah. And some people believe that short selling shouldn't even be legal. I mean, the reason short selling exists is originally so that you can hedge your positions. But the reason most people are short selling is to do the opposite. They want to speculate and take on risk. But that's a conversation for another time. We should move on. It appears the banking turmoil is not as ring-fenced as we'd hoped. After JP Morgan took over First Republic last Monday to save it from failure, several other regional banks started to quake. Metropolitan Bank and First Horizon were down 50%, Western Alliance down 60%, and PacWest shares fell as low as 70%, and the company said it was exploring a sale. They've all recovered slightly, and who knows what will happen by the time we air this. But my question to you, Scott, is what could we have done to prevent this? And what can we do now?
Well, and again, we don't know what's going to happen between now and when we air this program, but those stocks you're talking about have recovered somewhat. They're up between 4 and 8% today. And my guess is it's on reports that you aren't seeing the same level of outflows that you saw at Signature or Silicon Valley Bank or First Republic. It all comes down to the same thing, and that is if something's got to happen with FDIC insurance. And that is either the cap needs to be removed or dramatically increased. Because if you have a smartphone and you have over 250...
And sorry, can you just explain the cap for us?
Sure. The FDIC is a governmental supported agency, I think, but technically not a government agency. It charges a percentage of deposits to banks. If a bank has $100 billion, it says, okay, give us 28 million or 100, I don't know what they charge, a certain amount per year. And if your bank fails, we will make good on anyone with less than $250,000 in deposits. So you can say we are FDIC insured, and very few people will invest in a bank or make deposits in a bank that is not FDIC insured. So it's a good housekeeping stamp of approval that basically insures your deposits and gives people confidence that they can make these deposits, not lose their life savings. They don't have to do much more diligence than see the terms, those 4 letters, FDIC.
Yeah.
Now, what happens in an information age economy when you hear about bank failures and you have a phone and you can transfer assets seamlessly? Why would you not transfer your assets to a bank that is effectively FDIC insured to the moon? And that's JP Morgan. Because if JP Morgan has a bank run, the FDIC is Janet Yellen and Chairman Powell, who will just say to the bank, okay, the window is open. You can borrow as much money as you need from us to make sure that everybody gets their money out, that anybody who tries to withdraw their money from JP Morgan, it's no problem. It's no problem. So effectively, what you have is a series of banks that have unlimited insurance that are backed by the full faith and credit of the U.S. government, the banks that have become too big to fail. And then you have regional banks, which are only going to be able to attract deposits of $250,000 or less. And the regional banks play an important role. They have niche products. They cater to a certain type. You can bet there's regional banks in Texas that are very good at addressing the specific needs of oil and gas companies. Mm-hmm. You can bet there are companies in Michigan or banks that will write factor loans for companies that sell auto parts into the big 3. I mean, they're just going to be there's a great ecosystem of banks. Now, there might be an argument that these smaller banks shouldn't be in existence, that the banking sector is too fragmented, that we need a smaller number of stronger banks. You could make that argument. But be clear, you're just going to see a massive outflow from the outside, I call it the top 8 or 10 banks, or a massive inflow into the top 8 or 10 banks by deposits from everyone else. Because those companies, by virtue of being that big, effectively have FDIC insurance with no cap. Mm-hmm. So the big discussion that's likely taking place behind closed doors in Washington, D.C. is what are we going to do with FDIC insurance? Should we remove the cap? Should we dramatically increase it? Otherwise, what we're effectively saying is we want a much smaller banking sector. And the downside of that, or one of the downsides of that, is that when you go to buy your first house, there's going to be fewer people bidding on that mortgage, and fees are going to go up slowly but surely across every product that banks offer. So essentially the the regulators have a decision to make, and that is how much. The issue they have to wrestle with is the following, and that is the tension between having a more robust, diverse banking sector that is more competitive and offers people more specific differentiated service at lower fees, which is the wonderful thing about a highly competitive market, versus the risk of having a bunch of banks that might be subject to some sort of run because they're seen as more vulnerable. And that might be, I think they're either going to decide, yeah, we need a consolidation of the banking sector and won't do anything, or they're going to decide, no, we need regional banks and we're going to massively increase or remove the cap. What are your thoughts?
Well, I think that you're bringing up an interesting point about risk here, because it feels like this is all a giant question of who's going to assume the risk. And, you mentioned the idea of we could take off the cap and, it'll be backed by the by the credit of the US government. But in that case, to me, that is just a transfer of risk into another entity, in this case, the US government. And as we've seen, the criticism lately around our economy has been that the US government's response to things is, one, to pay for things with taxpayer money. That's been a criticism about this situation. There's some nuance there that we can get into. But the other issue is that the US government's response to problems is, let's print money and we'll just throw money at the problem. And don't worry if you take on too much risk as a bank, because we've got you. And how do we have you? We're going to print money to solve the issue, which of course is the driver of inflation. That is the reason that inflation has gone up 7, 8, 9%. And eats into the savings and the spending power of regular Americans. So to me, the question is becoming an interesting question of how do we tailor the cumulative amount of risk in the system, and how do we spread it out evenly in a way that's fair to everyone, and probably in a way that doesn't hurt the smaller guys as much as possible. And this is playing out in an interesting way because, these smaller banks are getting crushed. The JP Morgans of the world are killing it now. I mean, JP Morgan's going to assume $2.5 billion in profit from this deal. But it feels like that maybe there wasn't a choice, because we also had to protect the people whose deposits were in those small banks. So I guess my question to you is, how do you think about this idea of where we place the risk in the system? And I know there's no answer here, but what is the best way to do that?
The honest answer is I don't know. The Democrats will talk about the importance of having niche local banks. Everybody loves the small business person. I would bet there's a bunch of Congress people who were formerly the founder or the president of some local bank. And when you think about it, so what is it? The top 15 banks control 75% of deposits in the U.S. And just saying that, you think, well, it's a concentrated industry. We need more competition. What industry that's this size has that lack of concentration? There's one search engine that controls 93%. One social media company owns 2/3. If you took the top 15 automobile companies in the United States, they control a lot more than 75%. I bet there's 10 that control 80%. So this is not, I don't think you can make the argument that this industry is too concentrated. And these runs or these risks or these runs present real systemic risk. So the question is, one, should the banking business be more regulated? And I would argue that's a mistake. I think it's just a miracle if you think about this, all right? If I said, okay, I'm going to give everybody $120 to go invest in their own startups. And then they said, okay, what do you need for that? I'm like, well, I just need to get $100 from a variety of investors. And I'm like, well, how do you do that? How do you turn $100 into $120 of investor capital? It's like easy, as long as my depositor base is diverse, they're not going to ask for it at the same time. And even if the economy or my investments only grow 5%, I can grow the economy at 6% instead of 5% because I got additional leverage. That is the miracle of a modern banking system. So I think you want to encourage a certain level of promiscuous, risk-aggressive behavior. When Elizabeth Warren or Senator Warren says banking should be a boring business. It should be one-to-one, deposits equals loans. That's a bad idea. You're going to have slow growth. Nothing sucks more than an economy that isn't growing. So I think that something that encourages risk aggressiveness or a certain level of risk aggressiveness makes sense. My solution would be to dramatically increase the level of FDIC, the cap. Because what you might want to say is, all right, say you took the cap to $5 million. What would that mean? Probably 96 to 98% of all your depositors wouldn't feel the indigestion that you wake up with one morning or the fear that causes a run on the bank. Then the question becomes, well, do you create moral hazard because people don't do diligence on the bank that they're depositing money into? And I don't think they were before. I don't know. The question is, do you lose a certain amount of scrutiny? Do you create moral hazard? Do you potentially set the FDIC up for massive bailouts? But they've been covering all the deposits anyways. So I like a diverse banking sector. I do think these niche banks, and I'm biased because I got great service from SVB. I thought they were great at what they did, and my understanding is up until the very end they made good money and were a good company. So I wonder if you just don't solve this by massively increasing the cap. And what does that mean in terms of expense to the bank? Because right now there is no cap. They're paying out anyone. They're paying out at all. So I don't understand. I think I would want to battle test. Well, let's raise the limit. Let's not remove the cap, but let's raise it dramatically such that the majority of depositors just aren't worried. Just don't. You lose. If the cap had been 5 million, the majority of VC-backed companies probably would have said, we're fine. We don't need to pull our funds. We don't have more than 5 million deposited here. You'd lose some big guys, but maybe the big guys should be at JP Morgan. Anyways, that's my sophomoric thoughts so far.
Yeah. I know we're going on long. I just want one more point, which is a lot of people are saying that the taxpayers are paying for this deal because this is going to cost the FDIC $13 billion. The reality is that the taxpayers aren't actually paying for this. It's all funded by those fees that the FDIC takes from the bank so that it has this emergency fund. But the more reasonable argument that people are making, specifically that actually conservatives and Republicans are making, because Biden said taxpayers aren't paying for this, and then the conservatives want to bash that. And the reasonable argument is that taxpayers are indirectly going to foot the bill. And basically the idea... Sorry?
Depositors are paying for it. When you deposit...
But they make that, the depositor and the tax... Exactly, it is depositor, but they're saying the word taxpayer to indicate the average American, because everyone has to bank with a bank. And the idea is that what will happen here is that this will increase rates on the rate you'd have to pay on a loan, because the banks are going to have to make good on the difference that they lost because of this. I don't really buy it. I don't think it's that. What do you think of that argument?
The people that are paying for this are depositors. And that is, if you put $100 into a bank, a certain amount of it, probably, 10, 20, 40 cents a year goes to the FDIC such that your deposits are insured. And if we have a weak banking system and they keep going out of business and keep having runs, then the cost to you is going to go up because the FDIC is going to have to charge richer and richer premiums. So there is some truth to the notion that premiums that depositors, and the majority of taxpayers probably deposit money in a bank, are going to have to pay higher and higher fees if we have a banking system where big banks consistently go out of business and the FDIC has to show up. The same way that your insurance premium goes up in Florida when there's a lot of hurricanes and a lot of claims. The more claims, the higher the insurance premium. The question is, what is the balance, right, between what is the lesser of the two evils? An increase in FDIC premiums that ultimately get passed through to depositors, or the additional fees every depositor is going to have to pay, or every bank customer is going to have to pay with a less robust, less competitive banking system. That's the fulcrum. That's the tension between the two that smarter people than me need to decide. And by the way, just some data on concentration of industries. If we look at the airline industry, Americans at 19.5, Southwest 17.4, Delta at 16.3, United at 12.9, Alaska at 5.4, U.S. grocers, Walmart's at 18, Kroger at 9, Costco at 6.4, Albertsons at 4.7. So you're talking about these industries. The banking industry doesn't look more concentrated than some of these other big things. The difference is that the banking system, Kroger's probably isn't going to cause a run on the economy if it goes out of business. Although I would argue the food supply chain, if Walmart and Kroger's had said we're shutting down all our stores during COVID, I think you would have had a lot of people, most likely in Florida, who would have said, honey, grab the Glock, we're headed to Publix. So that would have been scary. But nothing creates the sort of systemic risk to the economy like the banking sector in terms of vulnerability, at least that I can think of. Mm-hmm. Maybe there's something else that presents more of a risk. But this does warrant additional scrutiny and really thoughtful people. But that's, if you will, it's the tension between increased fees and greater insurance premiums from the FDIC.
So Mia pointed out something interesting, which is that fintechs seem to have figured out a workaround for this FDIC insurance cap we're talking about. So SoFi, Mercury, and Crescent, all fintech companies, they all launched deposit products this month that are insured beyond the $250,000 cap. In other words, you can deposit $2 million with SoFi, and they'll guarantee that all of that money is protected by the FDIC's backstop. Now, the way they do that is by splitting your deposits into individual $250,000 sums, and then they spread those deposits across hundreds of FDIC-insured banks. Now, we wanted to find out how viable this idea actually is. So we spoke with Professor Sabrina Howell, professor of finance at the Stern School of Business. One of her focus areas is fintech, and as it turns out, she thinks emergent fintech companies could potentially fill the void left by regional banks if they continue to fall.
I actually think they're one reason why I'm less worried about consolidation in the banking sector, because these new fintechs are offering consumers like new options, high quality service at lower prices. Mercury, for example, is now the go-to bank for new startups. If you set up a business, there's no button at Wells Fargo or JP Morgan Chase to open a business account when you have zero revenue and zero operating history. It used to be Silicon Valley Bank was sort of the only game in town, but increasingly it's Mercury and a number of other new players. And they are looking to provide all of these, interesting new services, including spreading cash around to insured accounts. And I think there is this sort of growing role in providing new competition, not just in banking, but think about startups like a Blue Vine providing small business loans, partnering with a charter bank that actually does the origination as sort of like it's almost like a utility company, bank as utility company. Or you have big tech companies like Apple or Amazon providing consumers payments and banking services. And so I think there's actually a lot of really good reasons to encourage entry by these new players that are offering online financial services, and that they can become, the next iteration of what was the sort of smaller players, the regional banks, the smaller banks in the financial ecosystem.
A new civil lawsuit was filed against Coinbase, accusing company executives and insiders of avoiding more than $1 billion in losses by dumping their shares weeks after the company went public. Between Coinbase's listing in April and mid-May, the 9 defendants sold $3 billion worth of stock. That includes CEO Brian Armstrong, Mark Andreessen, and Union Square Ventures investor Fred Wilson. He sold $1.8 billion. Now, Scott, I put out a tweet about this last week, showing the amount that was sold. We can pull it up on the YouTube here. And I called it one of the greatest robberies of the decade, because in my view, Coinbase is a fundamentally flawed company, which is why the stock is down nearly 90% from its listing. And this, to me, feels like it was a giant pump and dump. The tweet pretty quickly went viral. A lot of people supported it, but I also got a lot of criticism. And the critics said, this is how markets work. Investors had the right to sell, and they sold at the fair market price. Where do you stand on all this?
Well, I think it's finally I think it's important that you're finally getting some love on Twitter. Look, your tweet, the greatest robbery, one of the greatest robberies of this decade. You're learning. Twitter's definitely the medium for you because let's be honest, that's a little bit hyperbolic. But look, there is the thing I think we're going to find out, especially about a lot of these firms, and in a direct listing, I don't think there's a lockup. You can sell right away.
Yeah.
Are we comfortable with people who know the company better than anyone else selling their entire stake? And they can do that. But should they be allowed to go on CNBC? Should they be allowed to weaponize their millions of followers to talk about what a great company it is as they are hitting the eject button?
And there are two characteristics about the fact that this was a direct listing, which you mentioned. And just to be clear, so a direct listing is when you sell existing shares, you don't need to issue new ones. So instead of getting a bank to underwrite it or go on a roadshow, as we talked about last week, you just list the shares directly. And as a result of that, there are no lockups. And a lockup is that period at which you're not allowed to sell as an insider. But because this was a direct listing, there were no lockups, so they could sell immediately. So the other reason that a direct listing is possible is for Coinbase is because it was a massive consumer-facing company with so much retail interest. And the only companies that have been able to go public via direct listing when they don't have those banks underwriting and selling the company to potential institutional investors are big consumer companies. Like the most recent ones have been Roblox and Spotify and Palantir. So to me, this was designed for retail, and that's reflected in the ownership of who owns Coinbase now. Almost half of it is owned by retail investors. It was also one of the most successful retail debuts in history. And then there's that second characteristic of it's designed for quick selling because they didn't have those lockups. And the question is it right to be selling what I believe is a totally broken company? And there's a ton of evidence to support this. I mean, half of their revenue comes from fees from trading shitcoins like Dogecoin and Tether and Luna. All of them have basically proven to be just joke coins or Ponzi schemes. They're embroiled in legal suits. I mean, they're having this issue with the SEC because they're listing cryptocurrencies, which are actually securities, which is illegal. Like the whole company is completely broken. And are we down for a system where it's possible and easy and okay for smart investors to sell broken shit stock to people who don't really know what they're doing? And that to me is the question here. It's not a question of legality. Maybe we could change the law, but if you believe that what they were selling, if you believe that what they believed they were selling was a bag of shit, then to me, you got to take issue with this. And that's why I feel critical of it. But people said, oh, well, this is how the markets work.
So as long as they can still wallpaper over this type of behavior with their very public investments in nonprofits, but I stand by what I said. A lot of these individuals don't build anything enduring. And capitalism, to a certain extent, is your obligation is to leverage your own self-interest to fix your own oxygen mask. But at some point, you'd like to think, well, the market's failing. The market is not warning people. And so the question is, if you sell over a certain dollar amount, if you are promoting a stock through certain media channels, should you have a lockup period? Or if it crashes, say, more than 90%, should you, in fact, be subject to some sort of clawback? Because there is a group of individuals right now who are more in the hype business than the investment or the building business. And these are the same people that, if you go to their websites, refer to themselves as builders. No, they're not. They're fucking carnival barkers taking advantage of FOMO, taking advantage of new platforms to, again, take unicorn feces and fling them at unwitting tourists to the unicorn zoo.
So the argument that they would say is that this is simply how VC works, that VCs invest in the private markets, and then once the company goes into the public markets, they have to diversify because VCs don't invest in public stocks. That is how VC works. That's how the whole system works. So what should they have done then? Like, what should Fred Wilson and Union Square Ventures have done? Say they're holding this thing that they know that, let's assume they know that it's kind of a shitty company and that $381 a share is too much. But what else are you supposed to do? I think is the argument that they would make. And I kind of don't really know what to say to that.
It's a solid argument. Their obligation is to their limited partners and to their own families. You have no friends on Wall Street. There's someone on the other side of the trade that thinks they are going to end up better than you. That's the basis of markets. The question is, should regulators move in, given there are new platforms, new kind of abilities to dump, new mediums, new platforms such that they can create hysteria, not based on any underlying fundamentals, and also new mechanisms of taking a company public such that they can sell with absolutely no friction. Whether it requires regulatory intervention, I don't know. That's for DC to decide. But things feel like they've gotten really out of control, where the pumping and dumping has gone parabolic.
Mm-hmm. Okay, let's move on to our third story. Miami hosted its second Formula One Grand Prix this past weekend, bringing celebrities, fans, and hundreds of millions of dollars to the city. 3-day passes ran from $880 to $5,000, making it the second most expensive race all year. But that was merely the cost to see the race itself. Off the track, there were tequila and caviar tastings, private clubhouses, garage tours, driver meet and greets, sleepovers on the Mercedes team yacht, and even tables at clubs like 11, which went for as much as $200,000. All told, the economic impact should be even higher than last year, when Miami's first ever Grand Prix netted $350 million in new spending for the city. So, Scott, you actually went to the Miami race last year. Can you tell us what that was like?
It's fabulous. I used to go to Formula One in Montreal every year. It's a great city. I love this. I love Formula One because it's more about an experience. It's more about going to a city for the weekend. It's got a fabulous crowd. It feels very elegant. If NASCAR is Android, Formula One is iOS. They've done an amazing job marketing it and getting celebrities and getting shows on Netflix about it. It's a brilliantly run company. Greg Maffei has done an amazing job with it. Specifically, Formula One Grand Prix Miami is where I caught COVID. I went to a pop-up party hosted by Carbone, a fabulous restaurant, and Wyclef John, is that his name? Wyclef was playing there, and there was 700 people crowded in a space, ridiculously hot people in a tent with no ventilation in the midst of COVID. And I literally thought to myself, I had two thoughts. The first is I'm getting COVID tonight, and the second is it's worth it. That's how good a party it was. So look, Formula One's bringing together a lot of attributes around leveraging new medium platforms for cross-promotion, celebrities, and experience that breaches beyond the 3 or 4 hours that you're at the event. The event itself, I find incredibly boring. Oh, here he comes, there he goes. It's just, I don't find it an interesting spectator sport. You're there to see the people. You're there to do a tequila tasting or whatever it is you do at Formula One. But it's an example of, it's not about the event. It's about the culture and the vibe and the experience. But they've done an amazing job. Liberty Media has tripled the value of F1. U.S. viewership has doubled since their acquisition, I think mostly through that Netflix program, which is supposed to be great. And 53% of U.S. F1 fans say Netflix Formula One, Drive to Survive influenced their fandom. So you're just going to see, this could be, I mean, the interesting second or knock-on order effect is you could see Netflix develop a new revenue stream by going to sports teams and saying, pay us $100 million and we'll do 2 seasons of what it means to play for the San Diego Chargers or a league. Or we're going to take the professional lacrosse league, the PLL, to the next level by doing we'll commit to 3 seasons of green lighting a series, and we want $50 or $100 million. And I think they would pay it. What's also, they've done a great job is they're bringing in younger fans. The average age of a Formula One fan dropped from 36 in 2017 to 32 in 2021, which is a huge drop. And also, you've seen an incredible growth in team valuations. Mercedes paid $176 million for the team in 2010, and it's now worth $1.5 billion, which is just incredible. You're going to see teams increase in value because as long as they keep creating men in midlife crises, as long as the 0.01% continues to aggregate more and more income, You're just going to see teams, the terminal value of teams, they're going to be shitty businesses in the short and medium term. They're going to lose money every year, whether it's the Washington Commanders or the Mercedes team. And then in 5, 10, 20 years, they'll sell at extraordinary multiples of what they were purchased at.
And then if you just look at the sponsorship deals, we've got like $100 million per year deal between Oracle and Red Bull. Petronas is paying Mercedes $75 million a year. I mean, is this becoming the new premier advertising space, the sort of the international rich people's Super Bowl?
Yeah, and this is my prediction, and then I got to hop because I literally have all these Brits showing up to eat Mexican food, and my dog's going crazy. Little insight into the dog. But my prediction is the following. What Ryan Reynolds did at Wrexham, what F1 is doing with Netflix, you're going to start to see that everywhere. You're going to start to see big media companies, celebrities, and streaming companies come together to build. It'll be Tom Cruise plus Disney Plus buy the Anaheim Ducks or whatever it is, or buy a league. And you're going to see a medium-sized league. So much money is coming into leagues because the bottom line is there's very few events that leverage the emotion, the income inequality, the emotional tribalism of the human species, the ability to find a new revenue stream for media companies, and recognize that kind of increase in shareholder value. We're about to see Wrexham, or what's happened at Wrexham, times 10 across leagues all over the world, including a professor with erectile dysfunction who is the new owner of Rangers, one of the strongest brands to come out of Scotland since Pringle and some famous Scotch brand. Anyways, I'm off to Cinco de Mayo. El Grande Perro Cinco de Mayo. Ed, have a fantastic week. Thank you for watching this edition of Prof G Markets. Please like, subscribe, and tune in next week where you will hear, Jesus Christ, if we're not anything, maybe we're not smart, maybe we're not right, but we are and we are filtered.